Okay, now we're sitting in front of our charts, we're ready to trade for the day. We've done our top-down analysis and we see a divergence setup developing. Now we need to assess that divergence trade. The very first thing that we want to see with a divergence setup or any type of setup is that it's happening at an expected level of support or resistance. Okay, this is going to give us a much higher probability of success. And again, this is for divergence setups or any type of a trading setup. And the best way to do this is to have these levels marked off ahead of time. Okay, when you do your top-down analysis, to have these levels marked off already so you can look for price to react to these levels. Okay, that takes away the potential for you to justify trading setups that just aren't very good. All right, we see a divergence develop. The pattern looks pretty good. It's pretty easy to find a reason to trade it. Okay, if you really want to trade it, you'll find a reason. Okay, but that's not the best way to trade. The best way to trade is to know where to expect support and resistance. Then when price reacts to those levels, you have that much more confidence and that much more of a probability of success. You also want to see, are there any major risk events coming up that could affect your trade? Now, obviously, this has more of an effect on short-term trading. Or if you're trading longer term and you're looking at, longer term setups, it's not going to have as much of an effect. But if you're trading shorter term setups, then you obviously want to look at your economic calendar, see what's coming out for that day, any micro events, macro events. Check the news on the TV, make sure there's no geopolitical events taking place that could create a really volatile market and could affect your trade. All right, so you just want to consider those risk factors. Has price had a strong run prior to the divergence developing? Folks, divergence that happens in a sideways market is just not very effective. Okay, so you want to see divergence that occurs after a strong run, and the best are after the market extends into a strong level of support and resistance, and then we see that divergence, then we see the strong price reaction. Those are the best divergence setups you're going to find. Okay, is the price reaction after the divergence, like we just talked about, is it sharp or sideways? So is it more of an impulsive look, or is it kind of slowly pulling down, maybe correcting pretty deep and then making another another cycle low? And we'll show this a little bit more on a price chart here, but the best divergence setups are the ones that have sharp price reactions after the divergence. All right, so you had the divergence and then bam, price just makes a beeline to test that support or resistance. Those are the best setups. Okay, price patterns will take their time, maybe move into a three-wave corrective cycle before even testing the high or the low. Those are not as good. Okay, the probability is not as high. They can still work out. They can still work out. And the exception to that rule is if we get an extension. Okay, and we'll talk about that as well. Okay, then once you've determined all of these factors, finally you want to see, is there a good reward to risk ratio for the trade? Okay, are there any major levels of support or resistance that could affect your profit target? Okay, so let's go ahead and have a look at some price charts here, and specifically right now I want to go ahead and look at, I think we all understand how to look for support and resistance. I'll show you a calendar where you can look for any major risk events for the day when you're going to be looking to trade. We'll look at a couple of examples of nice runs into a divergence setup, and then also we'll look at some of the price reactions after we see the divergence and how we qualify or not qualify a trade setup. Okay, so first of all, this is an economic calendar. You can use any economic calendar that you want to, but what I like about this is just Forex Factory, and this is just a pretty popular Forex site. It has a calendar on the front page, and you can see here these are color-coded. These little folders right here just show you high risk, medium risk events. Now you can also mess with the calendar over here, mess with the filter, and you can put low impact expected releases here as well, and they'll be in yellow. I just remove those because I don't really worry about those too much. I'm only concerned with the medium and high risk events that could create some volatility here in the market. Okay, so I know if I'm trading, around 8:30 Eastern time, that I have the unemployment claims coming out of the U.S. So if I'm trading on a intraday level, if I'm trading 5-minute or 15-minute charts, I don't want to enter right when this data release is coming out. If you're already in a trade, that's fine. I leave it open. I don't worry about that so much. But I don't want to enter into the market based on this data release. Okay, but even more importantly, see this right here, like the monetary policy statement, and we also have a Bank of Japan press conference. You know, I'm really not going to want to trade a short-term trade during this type of a deal, during a monetary policy statement, during any kind of interest rate statements. And just to kind of give you an idea, here of this is something that happened yesterday, and just let me get my chart down here. You see this right here, this candle right here? This was when the Fed meeting minutes came out. So this is when the detailed minutes of the most recent Fed meeting were released. And what happened was, you could see here, the market rallied really strong. Right up here, rallied really strong towards this resistance. And then we saw a strong decline all the way back down to this low. We're talking about, you know, in this price move, we're talking about from 111.40 back down to 110.68. All right, so almost, not quite, but almost 100 pips just in this 15-minute bar right here, up and down. Just up and down. Okay, we don't want to be in short-term trades during this type of event. We just don't. Okay, there's no probability here. And it's also very difficult to manage your risk because you don't know what's going to happen. And if you have any kind of leverage on trades at all, and you have slippage from these types of events, because there's no guarantee that your stop is going to get triggered when it's supposed to in this type of a market. You know, just ask somebody who was trading, you know, the Swiss franc a couple months back. You know, the SMB came out and shocked the market, saying they weren't going to defend that 120 floor anymore on the Euro Swiss, and the Swiss franc just skyrocketed. I mean, it took out traders, it took out hedge funds, it took out some brokers. All right, so don't think for one second that the market can't do some really volatile things. Okay, so just something that I wanted to point out. All right, so check for any major risk events on whatever calendar you like to use. Has the market had a strong run? Let's go ahead and look at this. We have price coming into a resistance level. And what do we see here? We have a divergence. All right, we have price moving higher. We have MACD cycling lower. Let me just go ahead and give us a little more room to work with here on this. So would you say price had a nice run here before the divergence? Absolutely. Nice run up in price, testing a previous resistance level. It's a figure right here. See, 100 figure. You think that's a key psychological level? 100? Absolutely. Price moving higher, MACD swinging lower. And then this is what we're talking about here as far as the sharp price run. Okay, so this is a very sharp price move right here. Very sharp price move. And that's something we want to see, is this sharp price move. This right here is a perfect example of a divergence setup. I mean, just picture perfect. You have price made a nice run into a figure, a key psychological figure at that. Previous price resistance, real sharp decline. Okay, then a three-wave corrective setback. It looks like right to the 62% Fibonacci retracement, or close. Retraced 62% and then took off to the downside. Where did it target? Is that the 127% extension? Absolutely. So this right here is literally a perfect MACD divergence setup. And this is what we'll see as what we call the objective, or the simple objective divergence strategy. And this is the same exact pattern we're going to look for. Here's another example of divergence. Okay, so let's say we're trying to assess a potential trade here. Now we have price moving lower, MACD cycling higher. So what happens here? We have this rally. Okay, we never come up to test this high. Never got there to test the high, so we wouldn't look to enter into that. We have another divergence here. Let me just go ahead and clear this off, and we'll look at that individually. All right, so now we have price moving lower. We have the MACD cycling higher. We have price, first of all, see how price approached this level? Remember we talked about a sharp price cycle? So what happens here? First of all, this didn't make another low. First we have this price move, this pullback, this move, this pullback, this move. Okay? Not a sharp price cycle. And we never broke this level. We never broke this level. Okay, so that's not a good divergence setup. Okay? Not a good setup. Continuing to move on. Again, price moving lower, MACD cycling higher. We have this rally. Now this, again, we're looking for a sharp setup. This is what we don't want to see. We don't want to see a rally, a pullback, and a rally. Okay? We don't want to see that, because that is a three-way pattern. That is potentially a completed correction. Okay, it can still play out, but it takes away the probability. It's not as probable. Okay, the other thing here is still we did not break this high. We didn't break the high. All right, so I'm just going to remove this again. Whoops. Sorry about that. Okay, I found our spot here again. Okay, this time we did move up and break this swing point here, right? Here was a divergence, we rallied up, but again, this is a three-wave cycle. Okay, a three-wave cycle is not something we're looking to trade like this. It's two sideways, three-wave cycle, two flat, so we would not trade that. Okay, and we obviously didn't diverge here, but even if we would have, this is just way too sideways at this point. Okay, way too sideways at this point to want to look for any divergence in this particular cycle. Okay, so even though we saw a lot of divergence, there was no trade. Here's another example of what would be a no trade, at least from this degree for a divergent setup. We have price moving higher, MACD cycling lower. Okay, that's good. We had a good run up in price. But then here, let me get the right drawing tool. Here you can see we have this type of a pattern. Okay, so just nothing here, even though we moved lower, there was nothing in here to qualify. This just wasn't very clear. Okay, so that would have been a no trade, at least until this point. And we'll talk about this a little bit more later, but at least until this point right here where this cycle extended. Okay, we have what was called a bearish extension right here. This is a bearish extension cycle. And you'll see the template here when I put on the bearish extension, what that means. It means that this cycle, okay, we had this leg down, this pullback, and then this cycle extended to that 162%. That's bearish. That's a bearish look for a continuation to the downside. Okay, we'll talk about that a little bit more later, but that was the exception to the rule right there with the extension. Now, in the same way, if we would have had right here, let's say we pulled down, rallied, and then this leg extended, okay, to the 162%, then we would have qualified that divergence as well. And then we would have looked to have sold the pullback. Here is a pound yen, and this is a weekly chart. Okay, and this is another example of an extension. Now here you can see we have price moving higher. MACD at this point is cycling lower, so we have a bearish divergence. Now, even though we have the price cycle the price cycle here corrected probably about 50% and then continued to the downside. If we put the measurement on this from the high to the low to the pullback here, you can see that we extended. See how this cycle extended through the 162%. That is a bearish look, even though this subdivided into three waves. And this was still a pretty sharp move anyway. But even though this subdivided into a three-wave pattern here, we would still look to sell the pullback. Okay, 50 to 62%. That's the area we look for a short. And here you can see in this scenario, the market pulled back 62%. And we had a nice move well to the downside here. Also, if we look at this again, let's just go ahead and see if we have another extension. Okay, actually, at that point we did not. So we just fell short of the extension here. So that didn't give us much of a clue on that particular cycle. But it came pretty close. But still didn't really give us much of a clue at that point because we really wanted to see it hit that 162%. So here at the top, we had a clear setup here for a pullback. Not so much once we moved down into this low. Although another thing we can point out here is that we did not have a divergence. Because what we talked about earlier, we did not have a divergence between the swings, and we were below the zero line here, both of which is bearish in this circumstance. Okay, so that's how we assess the potential divergence trades. Let's move on to our next section.